Thanks. Thanks for that, Yen. And good to be here, everyone. Just clearly we're blowing a bit of the virtual dust off our cobwebs here. But is my video coming through okay? If you guys can just confirm, and I'm just going to share my slides here as well. Just let me know in the chat. Make sure that that's coming through okay. That would be great. Perfect. Thanks, Alex. Appreciate that. Terrific. Cool, guys. Well, look, my name's Ben, and today I'm talking about how to build a second income investing. Look, before I kick in, big shout out to the guys at General Assembly and Self Wealth for putting on today. If you guys aren't already around what these guys are doing, check them out because they are up to some pretty cool stuff. But yeah, look, I think the new year is a great time for people to be thinking about their money. I think we think about a lot of important things in our life around this time of year. And, you know, money is one of these things that it's really important, but it's never really urgent like other things like, you know, health and well-being goals, why gyms are so full at this time of year. All of these things, they're hard to do and it takes a bit of work to get there. And I think that with money, like with a lot of things, that you need to really hack your psychology and your thinking and give yourself every advantage possible. So taking advantage of some of that New Year's motivation to take some action, start getting some results, and that's going to keep you motivated as we go through the year. To keep on the path and keep building that momentum. So hopefully I can give you some good tips and ideas, things for you to be thinking about today. And look, I think generally when it comes to money, people think that, well, it's a common sort of myth or thinking mistake that there's one sort of set of steps or pathways that any person can take to lead to financial success. But the reality is that the right approach, the right strategy, the right investments for every single one of you guys following along today, it really depends on you. It depends on where you're at now. It depends on what's important to you and how your situation is going to change over time. So today, instead of me giving you the 17-step method to become a millionaire in a short amount of time, instead what I'm going to help you do is understand the key things that you should be thinking about and aware of, as well as the key questions to ask, so that when you do come time to take some action, make some investments or whatever, that you know what to look out for and also help you understand some mistakes that you should be trying to avoid. So guys, look, before I get into the content, please don't rush out and make any life-changing decisions off the back of what we cover. I strongly encourage you to seek out personalized advice before jumping in. These are big, important decisions that have a big impact, for years to come. So you should be thinking about that anyway. Guys, everyone's situation is unique. And I've found this from talking to hundreds or thousands of people about their money over the last decade or so. But I've found that there are some really common challenges that people face when it comes to their money. And the three big ones that I've got here are information overload. It's like where, there's so much information out there, so many options, mixed messages, hidden agendas. And it's like we're sort of drinking from the fire hose, but it's hard to know who to listen to and who to trust. People also then struggle to find balance between how do they get ahead financially at the rate that they want while you live the lifestyle that you want. And then we've got the psychology and the FOMO, the fear of missing out, herd mentality, and the fear of making a mistake ties into this as well, that no one wants to do that dumb thing or be that person that makes a mistake and ends up costing themselves a bunch of money in the process, especially when it comes to investing that, you don't want to blow up your cash. And what happens is that people end up stuck, and it's not always stuck doing nothing. Often it's you just stuck doing the same thing that you've been doing in the past. But what that means is that you're missing opportunities to be getting better results and getting more out of what you have now. So today we're talking mainly about investments, but what I've found is that there are three key elements that you need to get right when it comes to your money, which is your structure, strategy, and solutions. The structure is about making it easy to save and manage your money and making it really crystal clear how much money you have to work with when it comes to how much can you invest or, build your savings or buy property or whatever. That ties into the next element, which is your strategy and having clear goals and targets, really understanding what success looks like and the different pathways that can take you from where you guys are right now to the ideal position that you want to be in for the future. And then breaking that down into a really clear action plan where you know exactly what steps you've got to take and what's coming up to actually get the results that you plan for. And then the third element is the solutions or the investments and the product solutions that you use to back up your strategy. So here you want to look to be getting reliable, consistent progress over time and avoiding the chance of downsides and setbacks and those momentum killing mistakes. Now, if any one of these elements is missing, it ends up dragging on the other. So it's not really 3 steps, it's really 3 elements and important elements to get right. If you're nailing everything, but you're missing a good structure, it's like you're working with a leaky bucket and it's hard to know how much money you've got that you can use for things like investing. If you don't have a good strategy in place, you're leaving lots of money on the table and you're leaving a lot of peace of mind and confidence on the table. And it's really difficult to put yourself in a position to take confident action or take any action at all, which is where obviously the results come from. And the last one there, if you've got bad investments in place, then you end up obviously blowing up your cash and costing yourself a bunch of money in the process. So today I'm going to focus in on the investment side, but I'm going to give you some insights into the other areas as well, because they all are naturally related. Before I do though, I just want to step you through the different stages that I see people go through with their money. And again, from talking to a lot of people about this over a bunch of time, that there are some key sort of discrete stages that everyone fits into, and what typifies or what sort of designates what stage you are in is 3 things. One is how quickly you're getting ahead with your money. The second is your ability to live the lifestyle that you want, to make the personal choices that you want. And the third is your ability to, how you feel about your money, rather, your peace of mind levels, confidence levels, stress levels. So the first stage that we see people in is this distress stage. And for people that are in the distress stage, they're not making any financial progress at all, or in a lot of cases going backwards. They're trapped from a personal or lifestyle perspective because they've got no money to make the personal or lifestyle choices that they want. And then from a peace of mind point of view, obviously they're stressed out. What I've found is that you can't actually get out of this distress stage without making a clear commitment to your money. I touched on at the start that money is important, but it's not urgent. So it's easy to let it go into the back burner for a tomorrow that never comes. But if you end up in this distress stage, it's absolutely not going to change without you making that commitment to, your own financial success. The next stage that I see people in is the stalled stage. And for people in the stalled stage, that's where you're now making some financial progress, but it's slow and it's slower than you would ideally like it to be. You're not fully stressed out from a peace of mind point of view, but you have that niggling thought in the back of your mind that there's more that you're sort of missing out on, or things that you should be doing. And then from a personal or lifestyle perspective, you're able to make some of those choices, but it often comes at the sacrifice of getting ahead financially at the rate that you want. The next stage that we see people in is the comfortable stage. And for people in this comfortable stage, that's where you're now starting to build some good momentum from a financial perspective, finding a nice balance between ability to live a lifestyle that you want while you get ahead financially at the rate that you want. And then from a peace of mind point of view, building a real confidence. The fourth stage is what I very technically labeled the killing it stage. And the people in this stage, you're, from a financial perspective, now getting some really rapid acceleration. You've got no limits on the personal or lifestyle choices that you can make because you've got tons of cash to do all of that stuff. And then from a peace of mind point of view, you're feeling completely carefree. As I said, it is a progression, and there are some key things for you to do to progress through the stages. The first is they're making that commitment. The second, to get from the stalled to the comfortable stage, it's about taking action and taking that action on an ongoing basis. So to get results, you need to do some stuff. It's great to have great ideas. It's great to have great plans, but the dollars come from the action. So you need to do that. And then, because everything is changing so rapidly these days, COVID situation, perfect example of that, and the impact on investment markets around the world, property markets, etc., as well as like just the increase of technology, industries, how we work, all these things. It means that, what's important to you when it comes to your money, what's going on with your money and what's going on in the world, they're changing all of the time. And when those changes, when you make some decisions with your money and then those things change and the decisions become not the very best thing based on the changes, means that you need to take more action, like review what you're doing so that you can continue to be on the front foot and taking advantage of all the opportunities that you have to get more out of what you've got. The key to getting from the comfortable into the killing it stage is really maximizing every single opportunity that's available to you. So squeezing every bit of juice out of your situation, making sure you're optimized from a tax perspective, doing the right thing with your investments, your debt. And what that does is it really builds that rapid that momentum and acceleration with how quickly you're getting ahead. Now, the maximizing every opportunity is a bit of a shortcut, because even if you're at one of the earlier on stages, if you start maximizing every opportunity available to you sooner, it's going to help you progress through the stages more quickly. So, as I say, that it is a progression and some important things to do to go through the stages, but it's easy to sort of oscillate and get stuck. So hopefully that helps give you a sense of some of the things that you can be doing, regardless of where you are there, to move to the next level. So guys, look, before we get into the nuts and bolts of investments itself, I thought it was important to just talk about structure and money management. Look, I'm not a fan of the B word, but having a good budget in place is something that really is an important part of building a second income through investing. And I'll talk about why by talking about sort of general money management principles, but then how that translates into practical day-to-day money management and banking. Now, when you're allocating your money, whether it's the surplus income, like your savings that you might get, regular savings from your employment income or whatever, or even money that you might have a bunch of cash sitting in a bank account, when you think about allocating that money, that you've essentially got two choices in terms of where you allocate the money to. You can either allocate your money to your spending today, as the name suggests, the things that you're doing now, or you can allocate it to your spending in the future. Now, if we think about future, allocating money to the future, what does that mean? Well, it's essentially your savings and investments. So we've got saving cash in a bank account, investing into shares, managed funds, ETFs, that sort of equities bucket, to use a little bit of jargon there, buying property, and there's clearly a bunch of different ways that you can do that, buying alternative investments like cryptocurrency, or paying down debt. And the last one is cranking your retirement superannuation fund, depending on where you're located. Now, it's the same 6 options that are available to any person, regardless of whether you're based in Australia, the States, somewhere across Asia. It's not rocket science what those options are. The challenging and sort of nuanced part, and where the biggest opportunity is what's the right combination of those options to get you the results that you want. But any of the 6 options that I just mentioned, other than just saving money in cash in a bank account, these are medium to long-term investments. Shares and cryptocurrency, obviously, they're quite volatile. They've got a lot of ups and downs. Property is really expensive to buy and sell, so you don't want to buy a property and be forced to sell it the next day. And then, your superannuation or retirement funds, that's money that will sit there, until you can access those things in the future. So when you invest into one of those areas, and assuming that you choose good investments, and I'm going to talk about how you can do that, I'll give you some sort of knowledge and information about how you can make sure that you do choose good investments. But assuming that you do have good investments in place, that the second important part is that you want to make sure that you're never forced to sell investments at the wrong time, that you're never forced, when you allocate money from the today side of the ledger to the future side, that you're never forced to bring it back the other way, because then you can let your good investments do what good investments do over the right amount of time, which is make you a bunch of money. So the question is then, how do you ensure that you're never forced to, sell your investments at the wrong time, or bring your money from the today side of things to the future side? And the key there is really just making sure that all of the spending that you want to do on the today side of things is provided for. So there are only so many types of expenses, and I won't get too far into the nuts and bolts of this, but these are the categories that we've got there. Fixed costs, rent, bills, and boring stuff. You're spending as you're walking around. Money, debt is everyone's least favorite category. Lifestyle is your travel fund and tech toys, and bigger ticket, but also discretionary type expenses. Now, for anyone that's setting up a plan, like looking to invest or setting up an investment plan, one of the important things to do earlier on is to go, okay, well, what money have I got coming in and what money's going out and where's it going, and broadly look at these categories and go, okay, we want to end up in a position where you're allocating as much money as you possibly can to the today side of things so that you can live the lifestyle that you want today. But then on the future side, that you're putting enough money aside to make the progress that you want and hit the savings and investment targets that you want. So often, it's about like list them out. In a perfect world, we go, what are all the things that we want? I know that when I did that for the first time, my savings number ended up in the red because I was like, oh yeah, I want to spend this much day to day, buy myself, eating out, entertainment, clothes, shoes, whatever, this much for travel, going to pay down debt. I had some debt at that time at a certain rate. And then my bills were X, Y, and Z. And when I looked at my number, it was negative. So often it means that you need to circle back and go, okay, well, what are the important priorities? Because good money management is really just good prioritization. So you need to think about what is actually important to you. Now, some people it's spending on the day-to-day on entertainment. For some people, it's paying lots of money for rent so they can live in a really nice house in a really nice area. Or it might be things like providing for schooling costs of kids and that sort of stuff. Other people, it's travel. For other people, it's saving goals. For most people, it's a combination of those things, but it's different for every person, and you need to figure out what's right for you. Now, once you go through that process and figure out, okay, how much do you want to be allocating to these different areas, and then how much you want to be saving, make sure that you're happy with what those numbers are, then it becomes, okay, well, great. Now we've got some plans, we've got some ideas and some results that we want to work towards. How do you make it as easy as possible to actually get there? So what we do is we actually run this as different bank accounts where you have income coming into one place and then filtering out into different buckets so that you've got the right money in the right places at the right time. You're essentially automating your savings and investment success, and you can just set your default to getting the results that you want, and you get on with your life and the things that you enjoy doing, knowing that your money's doing what it should be doing in the background. So I say everyone thinks that budgeting needs to be about like counting every dollar that you earn, or over the top restricting yourself. Not the case, but when you nail this, you get an extremely high amount of confidence to say, okay, well, I've got X dollars per week or per month or whatever that I can invest, and I know that all these other things are provided for, which should flow through to a lot of confidence in you pulling the trigger on your investments and mean that you're not caught short and forced to sell investments in the wrong time and end up losing a bunch of money as a result. So I hope that makes sense, guys. Actually, I should have mentioned at the start for everyone following along at home, as we're going through, if you guys have got any questions, feel free to throw them into the Q&A. I will happily sort of pause as we go through and answer any questions that you've got about the tactical, practical side of this or whatever else, as well as have some time for questions at the end. So look, yeah, the COVID impact and the ongoing COVID impact, which is, a thing. What does it mean for your savings and day-to-day money management? Well, we've got a bit of an opportunity to reduce our costs as our lifestyles are a little annoyingly limited at the moment. But being a little bit more defensive, I think, is extra important given the uncertainty around, potential for ongoing lockdowns, economic conditions, employment stability, and that sort of stuff. Also, with ultra low interest rates, though, it's a little bit more risky for you to be having more money in cash because inflation's going up and the cost of living is increasing at a rate that's greater than what you're earning on interest in a bank account. So if you've got a big chunk of money sitting in a bank account, you're most likely that's going backwards in real terms over the time as well. Got a question just before I move on from Gonzalo. Gonzalo says, how many bank accounts should we have? Well, look, I'll go back to my diagram here, but essentially when we help people do this, we normally have 5, although with the spending, like I know for myself, my wife and I, we actually have 3 separate spending accounts. We each have an individual spending account and we have a joint spending account for our household. With those, we actually run them with the separate banks, just so we've got a small barrier between us and the other money that's there. I don't actually look into my other bank accounts that much, other than to see our savings increasing and just to maybe once a month looking at the other accounts, making sure that they're all where they should be. So look, I think, and it's probably the question is sort of highlights a point that it's not, I'm not saying, obviously I'm biased and I think this system's pretty great because I was the one that came up with it. But what's important is that you just have a system, because everyone's a little bit different. So ultimately you got to find something that works for you. But just doing stuff and hoping for the best, it works for probably 2% of people that I've talked to, maybe 1%. So doing something and going, okay, this is working well, this is not working. Okay, what can we change? How do we get there? Then that helps. Although if you want to replicate this system and use it as is, then that's a good starting point, because you know that this has worked for, thousands of people to help them get results as well. So hope that helps, Gonzalez. Vivian says, how much do you recommend as an emergency fund as not investment? Yeah, it's a great question as well, Vivian. I think you've said 3 months as your ongoing like commitments, and I think that is a good starting point. It depends on the person. I was actually just chatting to someone yesterday that was early on in their investing journey, and they didn't have a lot of cash savings behind them. And we were talking about the fact that when you don't have investments and you just really early on, that it can seem like a really mammoth task to both build your emergency fund to, if you want 3 months of expenses, call it $10,000 or $20,000, and then invest on top of that. So sometimes if you know that you've got, $250 a week that you can save and or invest, maybe splitting. If you're really early on in the piece, you might put $50 into an investment account, $200 into cash savings, build it up until it hits $2,000. Say, I'm just making these numbers up, but then you might go, okay, $100 to the investment account, $150 to the savings, and gradually build it that way. So there's different pathways that you can use to get there. Really depends on you, but and it also, when it comes to your expenses, like we work with a lot of sports people, and it's like they have contract season, and sometimes there's the ability for them, for the players that don't have a contract that endures from between one season and the next, that they might not get paid for 5 months. So for someone like that, it might 5 months or 6 months in an emergency fund might be a better buffer than the standard sort of 3 months that a lot of people talk about. I hope that helps, Vivian. So I've got a few more questions there, but I'll move on and circle back as we go through, because there is a bit of stuff to get through. Look, I want to jump into investing basics now and give you some of the things to think about it and be across, so that you know what's what when it comes to your actual investing. Before I do, though, just talking a little bit about the COVID impact on investments and markets for people. That the first things here is that there has been some structural change in the economy in terms of what companies are working well. Obviously, we saw a big rise in tech because tech's sort of powering the world. We've since seen a little bit of a dip there, but then healthcare, cybersecurity, a whole bunch of different things there as well. Lots and lots of volatility in different segments at different times. And I think that the economic risk has increased. There's a lot of headwinds, a lot of big, numbers and swings and stuff happening in different markets, means that there is a bit more risk around now than has been before, with the governments and their epic sort of cash splashes both here and around the world, plus the ongoing uncertainty of COVID and what that means. Lockdowns. Obviously, the Omicron variant is seeming like it's milder and not impacting things on that side, but who knows what could happen from here. So I think being a bit more defensive makes more sense there. Look, there is artificial money that's flowing through in the economy. I'd love that free money from the government. Thank you very much, Mr. Morrison. But here and around the world, the last time I looked, and it was a while ago that I looked, it was like $500 billion had been spent, which is 10 times the amount that the government spent in the GFC. Similar sort of volumes around the world as well. So it is certainly artificial, although the government seems pretty committed to keeping it going. Obviously, it's pretty good for their election campaigns when they're giving everyone free money and stuff anyway. So who knows what will happen there. But that's meant that a lot of business is good for a lot of people. A lot of people I talk to that are having, it's a bit of a two-speed, because clearly there's a bunch of businesses that have been really heavily impacted negatively, and a lot of it is out of their control, which really sucks. But there are a lot of businesses that are doing really well, which means that it's different pockets of the economy, different pockets of investment markets that are performing as a result. Look, it is the downturns that make millionaires. There's a lot of really successful investors. And certainly if you look at things like the Forbes rich list and the people that end up being ultra wealthy, that normally it's when there's significant economic disruption and downturn that they make the most money. And I think for investors, that is particularly true as well, because a lot of people are being fearful. It's the time to be smart. And that's where you can do well as a result if you're smart and have a good strategy and have the confidence to sort of avoid some of that noise and take action. And I think the key to that is really having solid planning in place so that you've got that confidence to pull the trigger and execute and actually start getting the results that you want. So before I jump into the nuts and bolts of investing, I just want to share with you why this is important. And what I've put up here is an example around saving $1,000 a month and then investing it into the share market. I've used a return of 8.7%, which is like a return on a diversified international share portfolio over the last 25 years. So a very easily achievable return. Look, I should say that the past doesn't predict the future, and I was never here. This conversation never happened. But my personal view is that I think that the future is likely to represent the past pretty reasonably closely in terms of these numbers. So essentially how this example works, and apologies in advance for throwing a bunch of numbers at you here, but I think this is really powerful and important, that if you save $1,000 a month, you'll end up over the 12 months a year saving $12,000 over a 10-year period. So that's $12,000 a year for 10 years. That's $120,000 in total that you would have saved and then invested. But because over the course of that time, you would have got some dividends from your share investments, you would have got some growth on the funds as well, that your $120,000, if you'd done this over the last 10 years, would now be worth $190,000. So you see $70,000 worth of growth on the investments in that time. Then I've looked at it over 20, 30, and 40 years. So after 20 years, you would have put in 240,000. But because of this now, this compounding impact of time and money and the acceleration of that compound interest, that you would have 642,000. So you see that your growth in the first 10 years has been like 70,000, but over the first 20 years, it ends up being 400,000. So it's really accelerating there. After 30 years, you would put in 360K, but the value would be $1.7 million. So you see $1.3 million in growth now, serious acceleration. And 40 years, if you've done this for the last 40 years, you would have put in $480,000, but you've got $4.283 million, which is like a 10x return. So a lot of people, when it comes to their investing, that they overestimate how much they think they should be able to do in the short term, and they underestimate how much can be done in the long term. So hopefully this shows you that certainly over the long term, just by being small but regular and consistent, you can create some amazing results. And my tip to you, and where a lot of people go wrong, because we're overestimating how much we think we should be doing in the short term, is that you do some investments and you go, oh crap, this is really slow going. It's not getting to me where I want to be at the rate that I want to be there at. And so you get distracted, you get off track, and then you end up doing nothing, or you change direction, or you stop following through. But then you've missed all of this. You're about to sort of hit that momentum point, but you miss out on that. So the key is taking action, but then being consistent on an ongoing basis. And you can see, yeah, this is only $1,000 a month, which I get for all people. That might be challenging to do at some points in time, but realistically, it's like less than 4% of the average disposable income in Australia. And if you did $2,000 a month, basically every number on here doubles. 3,000, it all triples. So it gives you a bit of a sense of how powerful and how quickly you can get some serious results. But look, you can only manage the risk that you understand. And that's what stops a lot of people from investing, that they don't understand all the risks, where risk is coming from. They're worried about doing the wrong thing and blowing up their cash. So you end up sort of paralyzed. So what I want to step you through is the key areas where risk does come from and how they can be managed, so you can see what risk is left over and then figure out what you're comfortable with or what you want to do when it comes time to do your investing. The first thing I want to run through is your investment mix, and that's the mix between defensive investments like cash and fixed interest or bond type investments, and growth investments like property share, Australian shares, international shares. Now, defensive investments like cash and bonds, or what they call fixed interest or fixed income investments, there's a few different labels that people put on these, but essentially they are they're income producing investments. So like when you put money in a bank account, it generates you an an interest income, as opposed to actually you put $1 in and it grows to $2. It doesn't. It just generates you interest, which goes into your account. So they call them defensive because they're less likely to go backwards. When you flip over to the growth side of things and start looking at things like property, Australian shares, international shares, these are investments that are designed to actually grow, so long as you choose good ones. So you buy a share for $10 today, in 10 years' time, you would expect it to be worth more than $10. Yes, there is some income both from property and from shares, but the big part of the return that you get generally is that growth. But we also see with these sorts of investments more ups and downs. And the more you move from the defensive side to the growth side, the more ups and downs you get. But really, that split between your defensive investments and your growth investments, one of the biggest drivers of the returns that you'll get from your investment portfolio over time. Now, where some people go wrong with this is that they think about they think if you don't have a lot of experience with investing, that they're a bit more conservative in nature. So I might actually just jump a little bit, but what a lot of people think about when they think that when you go from a conservative portfolio to, say, a growth or a high growth portfolio, that you start getting a lot of bad risk in your portfolio, so in your investments. So what I've got here is I've got an example with two different companies. Company one in this example is a big, stable, call it a blue chip company, which just means well-established, big business, a lot of assets behind them, generally been around for a long time. And, even you could think about it in Australia, Commonwealth Serum Laboratories, or CSL, they're the largest company in Australia. Currently, they've taken over Commonwealth Bank as the largest company in Australia because they're the ones that are doing a lot of the COVID vaccine stuff in Australia, which is obviously huge at the moment. So CSL are still going to go up and down, but over the longer term, you'd expect them to go up. Now, I'm contrasting them here with a second company, which is a small, you could think of it as a technology startup company or a diamond exploration company out the back of Western Australia or something, that you see with that sort of investment that there's much more swings and roundabouts, many more ups and downs, and the ups and downs are bigger and longer because it's all dependent on these massive success of these businesses, and generally they either shoot the lights out or more commonly they go bust. Now, people think that when you start having a more growth focused investment portfolio, that you necessarily need to start including all of these, what I call bad risk, or the startup or small company risks in your portfolio. That is absolutely not the case. All it really means is that you have less, and going back to our slide here, that you have less and less defensive investments and more good quality growth investments in your portfolio. So something to be aware of. Now, investment timeline, even with the best investments, even with the big blue chip companies, and even some of the options that I'll talk about around index funds and just tracking the market overall, that we still see the share markets go up and down. And when there is a significant downturn like COVID, for example, or the global financial crisis in 2008, the share markets are generally down by 30, 40, 50%. Now, if you're forced to sell your investments at that time, you're going to be essentially crystallizing a loss and losing out on your investments. And that's why, going back to what I was talking about with the banking structure and the today allocation future, making sure that your today's looked after, so you're never forced to sell your investments once you put them in, that if you do, then you'd be forced to sell at a down point and you cop it as a result. Now, that being said, the suggested investment time frame for share type investments is 7 to 10 years or more. And that's because the COVID was a bit of a weird one, because the government's just stepped in and started, injecting so much money into the economy. But if you go back to 2008 and the dot-com bubble in 2001, that the share markets went right down and they stayed down for years into the future. So that means that if you wanted to get the right, good returns on your investments, that you needed to have the ability to keep your investments in the market for over that period. If you did, then the markets recovered and they've continued to go up beyond, any historical highs out the back of every one of those downturns. But if you're forced to sell at the bottom, you end up losing. Now, even though the investment time frame, or the suggested investment time frame, is 7 to 10 years or more, it doesn't mean that you need to hold your investments for that long. And we speak to a lot of people that a common one is like they want to buy a property, they've got a bunch of money in a bank account, but they also know that it's still going to take them a little while to actually build their savings to the level that they feel that they need to get the property that they want. But they don't want to leave the money just sitting in the bank account. So they look to invest, and they might want to buy the property in 1, 2, or 3 years' time. But they know that they have the ability to, and this is the conversation that we have before we help them actually invest their money, that they know that they have the ability to keep their investments held in shares, that if there is a big downturn, that they'll just leave the money there for longer, knowing that they'll have to potentially delay their property purchase. So that's one of the risks and one of the considerations when you are looking to invest, that you need to think about, like, is that going to fit? Are you prepared to do those things to leave your money there over the timeline that's there? So investment timeline is all important. I'll run through that when I talk about the strategy, how to plan a strategy as well. Another way to manage risk when it comes to your investments is through diversification. And it simply means just spreading your risk across multiple investments. So if you look at, going back to our example with CSL, compare that with CBA, two largest companies in Australia, they've both got different return profiles. If you got $10,000 and put half into CSL and half into CBA, the return that you get would become smoother because it averages out. The highs of one are balanced by the lows of the other, and you see that the return ends up being smoother as a result. So the more different investments you have in your portfolio, the smoother the returns and the less company-specific risks that you have with your investment. So if one company goes bust, even if it's a really big company, which is probably fairly unlikely, you know that it's only a very small portion of your portfolio. Whereas when you've just invested into 1, 2, or 3 companies, it's like a massive chunk of your money. So we love diversification, and I'll talk about some options that you can think about around that as well. In this slide, and this one's a little bit outdated now that I haven't updated it off the back of COVID, but essentially it shows the different, Australian share market, and it's the ASX 200, which is what you might see in the news at night or online, depending on where you consume your news. But it's essentially the 200 largest companies in Australia, and all of this information is publicly available. You can see them listed here. It's got the value of the company, and the combined value of the 200 largest companies in Australia is it was $1.67 trillion at this point in time. Now, how an index fund works, and I think this ties into a key investment decision that you need to make when you are looking to build another income through your investing, is that how an index fund works is it just replicates the exact proportions of the market overall. And then the return on an index fund is exactly the same as the return on the share market. That's called a passive investment or an index fund investment. And the alternative is what's called an actively managed fund, where they're investing differently to the market. They might say, I think this particular investment is going to perform better than another, or whatever. And then they go more heavily into those investments, or the investments that they think will perform best. Now, that's a key investment decision for each of you to make, is do you want to invest passively and follow the market, or do you want to invest actively and try to do better than the market? Pros and cons of each approach, definitely, but the stats show that like 85+% of actively managed funds fail to outperform their passive counterparts, essentially, over the medium to long term. Reason being is that the fees for active funds are much more expensive because they've got to pay the research houses and fund managers, and their costs are much higher. Whereas the index funds just have some computer algorithm that's passively tracking the market, and a whole bunch of accountants to collect all the dividend checks and take them down to the bank, essentially. So the cost differential is there. They both have their place. In my view, though, for people that are still growing their investments and assets, passive funds tend to be, I just had a bit of an issue there. Passive funds are great as you're growing your wealth. When you are, there we go. When you are closer to retirement or in retirement, actively managed funds can be great to give you different types of risk, essentially. So as I say, they have their place, but the stats show us what performs best over time. So the different types of investments that you can use to actually invest. So we've got shares, direct shares. That's like buying a share in CBA or CSL or whatever. Then we've got managed funds. So that's a pool of shares together in a portfolio. Exchange traded funds, which is sort of like a hybrid of shares and managed funds. Essentially, managed funds and ETFs are very similar. And the returns on them is are generally pretty similar as well, until you get to like the reasonable six-figure sort of volumes or seven figures even of investments. It really, in my view, comes a bit down to ease of use and ease of access for those, what works best there. And then we've got micro investing apps. So micro investing apps like Raise, Stocklight, Stake is another one. These ones where you can buy like parts of share investments or parts of crypto or parts of ETFs or managed funds. And I think that it's great to see the rise of micro investing, because for people that are just getting started, it can be a really easy way to get into the market. How you actually invest. So there are different ways that you can do that. One is with using a stockbroker, like old school stockbroker, mahogany desk type setup. They generally add value through giving you ideas around the different types of investments that you can use. But it's similar to an active approach, that there's not a lot that are consistently outperforming over extended periods of time. And stockbrokers are generally significantly more expensive than just using an online brokerage like CommSec or E-Trade or Self-Wealth or one of those sorts of ones. So that's the next one that we've got there. Then we've got apps like micro investing apps like Raise and Stake, etc. Going directly to the bank. So if you go into your bank and tell them that you want to invest, they'll generally offer some managed funds or stuff that you can buy over the counter. Or you can use a financial advisor that can help you actually set up some investments as well. And I'll talk a little bit more about that as we go through. But each of them have their merits, and it really depends on where you're at and what it is that you're trying to achieve that will dictate what are the options that you should look at most closely here. So, look, I think the key here, hopefully that's given you some ideas in terms of the things you should be thinking about when you do invest. In terms of putting it into action, it's about understanding your investing, choosing your strategy, growth versus defensive, active versus passive, how diversified you are. Then get started and be consistent, making sure, though, at the front end that you're optimizing from a tax perspective, because how much tax you pay on your investment dividends and income and returns, that all has an impact on the after tax return that you get, which is really the important thing there. So being smart with your tax, and the rules are obviously pretty complex, but being across those rules early on, it's going to mean you get things structured the right way from the start and save yourself a bunch of money as you progress and as your portfolio grows in particular. And then also understanding where property fits. And I put this up because today we're talking a lot about buying shares, and I think shares, ETFs, managed funds or whatever. And I think all of those investments are really great. But property, especially in Australia, is extremely powerful in that you use a deposit and then borrow a bunch of money to get this big asset working for you. And it can, $100,000 that you use to a share portfolio versus $100,000 that you use as a deposit to buy a $500,000 or $1 million property. Those two, the share portfolio is really going to struggle to keep up with this investment that's 5 or 10 times the size. So not saying it's the right move for everybody. And obviously, I think it depends on your strategy. And I'll talk a little bit more about that in a sec. But knowing where and when that fits into your strategy is something that's probably going to be an important part of being as successful or like reaching your financial potential as well. So guys, I've got this, I just wanted to share this process around how you can actually plan your investments and plan with your money more generally. These are the key steps that we've got through here. So I'll explain how they work, but essentially, if you're looking to, be smart and be strategic with your money, the key steps that you need to go through is first focus on what's important to you. Then clarify all of the things that are going to impact your plan. So what money's coming in, what money's going out, where's it going? Let's stress test that, make sure it's exactly where it should be. Then having, understanding the different strategic options, buy shares, buy property, save at different amounts or whatever. And what is the financial impact? What is the risk? How are we managing the risk as well? Once you're clear on what your strategy is, you want to break it down into a really clear action plan where you know exactly what the steps are, what you're doing now and what's around the corner. and then automate as much as you possibly can so that you can get out of the way and let your money do what you want it to do and get the results that you want. And then from there, that ongoing action, ongoing execution. So making sure that you're on the front foot, that as things change with what's going on with your money, what's going on in the world, and what's going on in markets, that you're still making the most of every opportunity that's there. If things are really simple, this can be something that's simple to do on your own. The more complex it is, the more value it is, and the more you should probably think about getting someone to help step you through it, or the more nervous you are about stuff as well, because when people are just trying to figure this out on their own, you can still have that big hesitation around pulling the trigger, which is obviously where the results come from. So having someone to guide you through, knowing that you covered all the bases, that there's nothing that you're missing that you should be thinking about, it goes a long way to driving the action that you need to get the results that you want. The planning impact for COVID is, you want to plan fast, even if you end up acting slow, because it all ties into that peace of mind. Don't not act out of fear. So sometimes not acting is fine, but don't just do it because you're afraid. Do it because you're informed, and be more defensive, as I talk about with the economic conditions as well. Really important. So I'll dive into some Q&A in a sec, but I just want to run through some myths and mistakes that I see people make with their money. I'll do these quickly because I can see that there's a bunch of questions in the box there. So the first one is that you need an advisor to invest. That is a total myth. You definitely do not need an advisor to help you invest. You can use any investment app, product, or whatever, and do that yourself. Where an advisor helps is with that strategic planning and guiding you through that process that I just explained, to make sure that you're doing everything that you possibly can and that there's no bits that are missing. Once you know how much money you've got to invest, the actual execution part is the easier part. You don't need to shoot the lights out with every investment that you make. I think it's natural in our psychology that we want the next, Afterpay or Facebook or whatever. But when you look at like that example that I shared before, where you see that just getting your boring old 8.7% a year from investing in the market, it is extremely powerful over time. So don't fall into the trap of thinking that you need to run excessive risk to get excessive returns, because just being consistent will get you there. Shiny brochures and good marketing is what I mean by this does not equal good returns. So you're going to make sure that you're cutting through a bit of that fluff to ensure that there's substance behind the sizzle. In Australia, definitely all investment products are legislated or regulated under APRA, the Australian Prudential Regulatory Authority, which means that it doesn't matter at all whether you use the biggest fund manager in the world or the newest startup going around. As long as they've got a financial services guide and a product disclosure statement, there is no risk with the company themselves. The risk actually sits with what investments you choose. Investing mistakes, making choices in isolation. So here you want to just make sure that like your investment fits in with your bigger picture and where you're actually headed, so that all the elements of your situation are moving in the same direction. Seeking the best option for the engineers and school teachers on the line. That analysis paralysis is so common, but sometimes just taking action and getting a very good option and getting the action now and getting the results now is better than waiting for this best thing that we never know what it actually was until after the fact. Unconscious prioritization just means, prioritizing the wrong things in the moment. And that's why it's important to be strategic and think 50,000 foot level when you're setting out your plan. I touched on before, there's no set and forget money strategy. And then trying to figure this all out on your own. Like I think that with money, because we all get paid into a bank account every week or month, that we think it should be easy, that it should be something that's simple, especially for high achiever young professionals, that you feel really confident, you're smart, switched on, good with your job. But so you think that money, you should be able to just do it, but it's its own speciality and its own intricacies, that you fall victim to your psychology. You're not taking advantage of opportunities. You're not being as aggressive as you should be when it's warranted, and sometimes being too aggressive when you should be a bit more defensive. And talking to advice with an agenda. I won't get into this in too much detail, but commission payments and kickbacks and product fees and associated parties all tie into this takeaway from the confidence that you've got. My totally biased view, because this is what we do, but essentially just fee for service, fixed dollar-based fees from your providers means that you know that they're just in your corner trying to make you really happy, so you keep working with them. So guys, look, I'm just going to share this model. I'll give you the really quick version of this around your progression from where you are now to future state when it comes to your money. In the future, each of you listening along is going to be in one of 4 positions, ranging from essentially really bad to really good. When people think about getting from where they are to this future state, they think of their progression like a straight line, but because of the compounding impact of time and money, it's actually a curve. And look, if you're not 100% on track to end up exactly where you want to be with your money, there are some things you need to do to get there, to what we call jump the line. So you need to be smart with your tax, do some things with your investments, etc. And once you do jump the line, then you just need to take the next step and the next step and the next step, which becomes easier. But the longer you leave it, the more time goes on, the more difficult it is to actually jump the line, the more painful it is to put in the work and get there. And putting yourself in the best position becomes impossible. So the sooner you start, the easier it is, and the more quickly you can actually get the results that you want, which is obviously why you do those things in the first place. So look, this is my pep talk, my bit of motivation, that regardless of what you want to do, if you want to build up a passive income of $5,000 a month or 10 grand a month, the easiest time to do that is right now, and the longer you wait, the harder it's going to get. So guys, look, I hope you have found that helpful. Look, obviously this is the sort of stuff that we help people with. Recognize that, sometimes we can just point people in the right direction, but if you want to talk about like how we might be able to help you, I've actually just put into the Q&A there, and I'll jump onto questions, but I've just put into the Q&A if you want to have a quick 10-minute chat with one of our people about whether we might be able to help, or if we can't help, the things that you could be doing now to put yourself in the best position possible, then check that out. And look, I can see that there are a ton of questions, but and apologies to the people that have posted their questions in. I will get a copy of that from the GA people, and I'll do my best to ping you guys a note. Feel free to hit me up directly if you've got any questions or stuff that you didn't put in there that you want to run past me. Sorry, we just had that bit of a tech issue at the start that meant that we're a little bit tight on time. But guys, I've got a handful of events coming up with General Assembly over the next little bit, so check them out on the GA page. And if you want more of this sort of content, there's a ton of stuff on the Pivot Wealth website, pivotwealth.com.au. Yen, I'll hand it back over to you.
Thank you, Ben. All right. So can everyone see my screen now? Excellent.